The US has been cooking the books during an election year to overstate the employment data and make the economy look stronger than it really is. This is the accusation that's being leveled at the BLS, and this is the latest stock market news that we need to be paying attention to. And I'm going to show you in today's video what's happened, why it's very important for the US economy, and why it means that the Federal Reserve could be now making a policy error. And I'm also going to show you exactly what this means for the US stock market. Starting with this Bloomberg headline, US payrolls marked down by the most since 2009 in preliminary data. Early revisions showed 818,000 fewer jobs in year through March. US job growth was probably far less robust in the year through March than previously reported, keeping the pressure on the Federal Reserve to cut interest rates next month. The number of workers on payrolls will likely be revised down by 818,000 for the 12 months through March, or around 68,000 less each month. According to the Bureau of Labor Statistics preliminary benchmark revision, it was the largest downward revision since 2009. So this is a pretty staggering downward revision to the jobs data, and it has severe market implications because what it's suggesting is that the US economy has not been as strong in the last year or so as the payrolls data has suggested. And all eyes have been on the labor market in the US because the US is the world's largest consumer. So if the US goes into recession, the rest of the world is going to go into recession. If the US economy remains strong, then the US can keep spending, consuming, investing in the rest of the world, and it can actually keep the rest of the world from tipping into a recession, into a global recession. And we've seen the US really outperforming its peers internationally recently. But this data is suggesting that actually the outperformance is not as strong as may have been previously suggested. To put this number into perspective, we're talking about a number which is larger than the entire population of Seattle being wiped from the US labor market. And the sheer size of the revision has caused a political spat, with the Trump campaign on Wednesday launching what Politico described as an all-out assault on both the Biden administration and the Labor Department's data collection practices, claiming fraud, cooking the books, as well as election interference. The campaign went on to say that the Harris-Biden administration has been caught fraudulently manipulating job statistics. And if we look at the revision compared to previous annual revisions, you can see it's not uncommon for the jobs data to be revised higher or indeed lower when we get these annual benchmarkings. However, this particular revision is the largest since 2009. And again, it's the sheer size of the revision that is leading to these political accusations, as opposed to the revision itself, which otherwise is not that uncommon when you have these annual benchmark revisions each year. So this was the bombshell piece of jobs data out on Wednesday, which has caused this political spat. But what we're interested in really as traders is what are the knock-on effects and ramifications of this to the US economy and to the US stock market, because the implications, not just for the US economy, but the global economy, are significant. If we pick it back up with Bloomberg, you can see the revision suggests the labor market started moderating much sooner than originally thought. This is the key to understanding why this is such a big deal for the markets and for the US economy. It wasn't until earlier this month that markets and economists grew concerned with the release of the July jobs report. That set off alarm bells with a weak pace of hiring and a fourth month of rising unemployment. But other metrics like jobless claims and vacancies have suggested a more moderate slowdown. And Wells Fargo highlights in a note the exact dangers of this revision, which is that the risks to the full employment side of the Fed's dual mandate are more salient than many believed before this revision came out. So this really hits the nail on the head of why, for markets, this major revision to the downside in payrolls is a headache, because you've got that dual mandate of the Federal Reserve. There, on the one hand, they've got price stability, controlling inflation. On the other hand, their dual mandate is full employment. So in other words, they have to control inflation and they have to get people jobs, right? Basically. But the problem is, in order to enact monetary policy to control inflation, very often you're raising interest rates, let's say, and this increases unemployment. And if you lower interest rates, yes, you can get people back into work, but this is inflationary. So they constantly have this seesaw between the dual mandate of price stability and also full employment. Now, how they decide to deploy monetary policy in order to adjust for one or the other is with the macroeconomic data. And you've often heard the phrase, the Fed are driving in the rearview mirror or looking in the rearview mirror. And this is because they tend to use coincident data like CPI, like non-farm payrolls, in order to enact their monetary policy. And the problem with this is, CPI, yes, it's coincident. Non-farm payrolls, yes, it's coincident. But it is kind of lagging, by at least a month in both of those cases. Now, add in to the fact that the non-farm payrolls data has been looking stronger than has been reported for over a year, it suggests that the Federal Reserve have probably been making monetary policy decisions on the basis of the economy being much stronger than it really was. In other words, it's a policy mistake in the making, because if you think the economy is very, very strong and you're holding interest rates, what you're doing is you're causing more deflationary impulses through the economy at a time when the economy is actually weakening. And maybe you should be doing the opposite and cutting rates, because don't forget, monetary policy operates with a lag of about 15 months. So any rate cuts now are not going to feed in until about 15 months' time. So you want to be cutting really at the right time. But if you're looking at data which suggests the economy is doing much better, especially on the employment side, then you're going to hold interest rates at a time when really you should be cutting them. And this is what's now got people asking, have the Fed actually made a policy mistake here? And have they kept rates too high for too long based on a large overestimation of the payrolls data? So if we have a look at the table itself from the BLS, you can see this was the piece of data that got everybody up in arms. And you can see the total non-farm benchmark revision at the top, minus 818,000. But what we're looking at here is really to see where the revisions themselves have primarily been coming. And when we do that, we can see this is mainly in the manufacturing industry, the retail trade, professional and business services, and in leisure and hospitality. So what we're actually seeing here is the major revisions have been coming in some of the most cyclical and sensitive industries to the business cycle, which is suggesting that this recent monetary policy from the Federal Reserve has really been biting, and it is actually starting to weigh on the US. And we are really seeing a slowdown in the US greater than what has previously been expected, or rather suggested by the payrolls data previously. And if we look at this note from Anna Wong of Bloomberg Economics, you can see payrolls for April and July 2024 are the most likely to be revised to close to zero, well below a pace consistent with a neutral unemployment rate. And if I pull up this chart, you can see exactly where a potential Federal Reserve policy mistake is unfolding based on the overestimation of the payrolls data over the last year or so. Because what you're looking at here is the gold line is the federal funds rate, and the blue line is the non-farm payrolls data each month out of the US. And the red horizontal line here is simply the zero bound. So in other words, when non-farm payrolls come out at zero, that's where this red line is. And what you can see historically is whenever we start to get non-farm payrolls at the zero bound or turning negative, we get a rate cutting cycle. When non-farm payrolls turns negative or is around the zero bound, we get rate cuts. And you can see this all the way through, rate cuts coming as we start to go near the zero bound in non-farm payrolls. And so what we're seeing here is all the way through history, when we get non-farm payrolls down near the zero bound or in negative territory, the Federal Reserve should already be in a rate cutting cycle most of the time. At the very least, they should be cutting rates coincident with non-farm payrolls at the zero bound or turning negative. Why? Because again, it takes about 15 months for the monetary policy to feed through to the economy. So even if you see non-farm payrolls coincident data coming out this month at zero, if you cut rates now based on that, this is not going to feed through until 15 months' time. So you're already going to have lagged effects of monetary policy. Now take into account the fact that the Federal Reserve maybe should have been cutting rates earlier on in the year, in prior months, and instead it's delayed rate cuts until potentially September or next month because the payrolls data has been coming out better than expected. So what this means is that necessarily, if that's the case, the Federal Reserve are now behind the curve in terms of monetary policy. And you can see here, we're sitting at 114 in the payrolls data, and interest rates are still being held. There is no rate cuts coming in the US as it currently stands. So what this is telling us is that in reality, Bloomberg Economics are suggesting we are actually down in this area, not even now, but in prior months before now, suggesting that the Federal Reserve should already potentially been cutting rates. And so this right here is the policy mistake that many investors are now saying is being made, and why you can see investors are suggesting that the Fed is now behind the curve based on those massive revisions to the downside in the payroll data. So what does the Federal Reserve being behind the curve actually mean for markets in the US economy? Well, what it means is that Federal Reserve are raising rates later than they should be because they've been using data which has basically looked better than it really was. And as a result, there's more economic damage that has likely taken place due to the monetary policy than would be necessary if they just had the correct data along the way. And so very much like somebody who can't swim maybe being underwater, you think that they've been under for a very short period of time, but actually they've been under the water for a lot longer period of time. This is going to lead to a much worse outcome to that situation. And that's exactly what we've seen with this massive downward revision in the payrolls data. So I want to finish off just by looking at the impact this is likely to have on both bonds and stocks. And you can see if we pull up the TLT chart and we can see relative to prior rate cutting cycles, as rate cuts start to come, this is bullish for bonds. We start to see rates coming down. We start to see bonds going higher. So what we've just seen with the downward revision suggests at the worst case scenario has held interest rates steady far longer than it needed to or should have done. But in the best case scenario, what it suggests is that rate cuts definitely have to come soon if non-farm payrolls is already at the zero bound and heading into negative territory in the near term. So if that's going to be the case and rate cuts now look not just inevitable, but necessary sooner rather than later, bonds in the US are likely to be one of the biggest winners of this, because as interest rates come down, bonds move higher, and as interest rates go up, as we've seen since 2021, bonds move lower. So to wrap up the video, if we pull up a chart of the S&P to see what impact this is likely to now have on the S&P, you can see historically, and I've got hard landings marked with dashed levels, vertical levels. You can see historically rate cutting cycles tend to coincide really with one of two things. Either we get a big kind of sell-off and a crash in stocks, and that forces the Federal Reserve to actually cut rates in response, or what we see is we see markets pushing into new highs and the rate cutting cycle starts with stocks near their highs. Now, historically, when you have stocks near their highs and rate cutting cycles start, you can see you tend to get a bigger sell-off in the S&P 500 following the rate cutting cycle. You can see that being the case over in 81. We get the rate cutting cycle and we get a continued sell-off. The prior two sell-offs, you can see where we had hard landings, we start to get rate cuts after in response to the market crashing. And when you get rate cuts in response to the market crashing, that tends to be bullish, historically speaking. Over here, you can see the 80 crash and we start to get rate cuts in response to it and it's bullish. But when you start to get rate cuts with stocks up near their highs, this tends to be followed by a bigger sell-off or a bigger correction, or for want of a better word, a crash in the stock market. And you can see this is the case with 01, we get the bigger sell-off. This is the case with 07, we're at the peak and we get the bigger sell-off. This is very much the case in 2020. We get the initial sell-off, we get rate cuts coming, and then we get, after the rate cut and the market pushing into highs, we get the COVID crash after that. Again, that is a very anomalous kind of crash and situation because it was the manual shutdown of the economy, which is not really something that has any historical analogy. And so if we come finally to where we're currently sitting, you can see we are just shy of all-time highs in the S&P. And if we're up near all-time highs in the S&P 500, and the jobs data is now showing us that the US economy is not as strong as previously thought. And this puts, therefore, the Federal Reserve behind the curve and makes a rate cutting cycle imminent. What does that mean with the S&P 500 right near all-time highs? It means, historically speaking, we should expect a larger correction in the US stock market ahead. So that is it from me for today, guys. As always, I hope you enjoyed today's video, and if you did, why not consider joining us in the GMT training room each day, where I look at the best markets as well as sharing real-time setups that I'm personally looking at trading with members as part of our GMT training program. Don't forget, you can also get a 2-week free trial to the cutting-edge Hedge-trading app used in today's video by heading over to www.hedge-.com. Access to the cutting-edge Hedge- platform is included with every GMT membership.